DBS. OCBC and UOB will be reporting results for Q1 2023 soon. UOB will be reporting on the 27th of April. DBS will be reporting on the 2nd of May. OCBC will be reporting on the 10th of May. With the local banks accounting for more than 40% weightage in the Straits Times Index. The combined banks' performance has allowed the index to eke out a slight positive gain of 3% year-to-date. The profitability of Singapore banks is likely to continue to grow, with wider margins and well-contained credit costs supporting record earnings in 2023. Says Fitch Ratings. Higher profits and muted loan growth will increase capitalization, which may encourage some of the banks to undertake inorganic expansion in the near term. Even as we stay optimistic on DBS, OCBC and UOB, we should be cognizant that net interest margins are likely to moderate in second half of 2023 as funding costs catch up. The negative impact into the bank's margin outlook is real as costlier fixed deposits are preferred by customers compared to low-cost current and savings account. Looking at the local borrowing costs in Q1 2023 suggests that the largest increase in the interest rate upcycle environment could be over. The market now expects that the Fed will deliver its last 25 basis point hike in the May meeting and then keep rates on hold until November or December. It is likely that the bank's net interest margin will have less room to increase. This will reduce for earnings outperformance we have seen in recent quarters. Singapore's bank lending data revealed that the total loans and advances have continued to moderate since the start of the year. This supports the view that loan demand could have seen its peak in August last year. Downside risks to economic conditions remain on the table, with a pause in tightening by the Monetary Authority of Singapore, MAS, this month while guiding for a deeper than anticipated slowdown. With talks of a global recession following the recent banking fallout in the USA and the collapse of Credit Suisse, it is sensible to expect financial stress on businesses and consumers in the coming months. This will affect the bank's earnings and asset quality. Still, we don't want to be too pessimistic as asset quality risks remain manageable and incremental credit impairments from higher debt service burdens are likely to be well covered. This is due to the sizable general provisions that the banks hold on their books. This buffer of management overlay allowances insulate the bank's earnings from excess credit losses. Capital ratios are likely to rise over the next 12 months and we could see the three banks returning more capital to shareholders as investors for income. This will be good news to us. However, the banks are eager to expand overseas and having higher capital on hand may not mean higher dividends for shareholders as it may encourage banks to undertake more acquisitions overseas. Tighter credit conditions in the U.S. banking crisis aftermath, plus an impending pause in the U.S. Fed's rate hike cycle could lead to the common stock of the local banks being sold down despite their relatively strong capital levels. This will provide opportunity for long-term investors. DBS, OCBC and UOB will continue to bring home the bacon, and if we are not invested yet, we might want to get some when there is a correction in the prices of the common stock. However, we should not think that they will continue to grow their earnings as quickly as they had in recent quarters. Personally, I will probably nibble at DBS at $30 a share. OCBC at $12 a share and UOB at $28 a share if these prices should ever be tested as supports. Good luck to us all.